With a deposit token, the difference is you're not handing your money to a third-party non-bank. You actually just hand it to the bank, and the bank issues the token directly. And so that money at the bank is a deposit. And so we call these deposit tokens as opposed to stable coins. And so the money is just sitting there in a bank account. You have essentially a bank account, and that's what the private banking system does. It takes dollars, holds one on reserve, usually with the Federal Reserve, and lends the other 9 out. With stablecoins, you don't do that. If stablecoin money comes in, those dollars are supposed to be there. They're by law very restricted, and they can't be sent out and basically lent out the way the banking system works. And while that might be very safe, having a system that's based on one-to-one reserves collapses the credit function of the banking industry. And it's like going back to kind of like the gold age, which some people want to do, but they have to remember that was extremely restrictive, and it really collapsed the ability of the country to grow. Well, we could do identity in sort of an old-fashioned siloed way, which is this one bank knows this identity. And if you're sending money to someone else who's banked at another bank, they know that identity. And you have this problem of like, well, I know my side, you know your side. We don't know each other's side. Or you could have an identity system that's more self-sovereign, more bottom-up, where people just have identity. It's kind of like their phone number. They take their phone number. If they switch from Verizon to AT&T, the phone number goes with them. If people's identity is self-sovereign, what that really means it's just controlled by them, it's portable, it's interoperable, then it doesn't really matter which app you're using, which bank you're banked at. If you've got a dollar and it's represented, why doesn't it have just dual use? It has both a bank account number, but it also has a crypto address. And so it doesn't matter. You know, if your paycheck comes on the old-fashioned banking rails, that's fine. But if you want to enter into a DeFi contract for a loan, you know, on a DeFi protocol, that's fine too. There's no reason a dollar can't have 2 addresses and operate in both worlds.
If you're a listener to the All In podcast, the other week, Chamath Palihapitiya, one of his calls for 2025 is that US dollar-backed stablecoins are going to be the big winner. You know, stablecoins have sort of dominated the conversation, especially in the digital asset market. It's a market that's expected to reach trillions of dollars in issuance in just the next few years. And now we have an incoming administration that has literally gone all in on crypto, expected to be very friendly for the industry. We have a new SEC chief that Trump has named, Paul Atkins, again, expected to be very, very crypto friendly. And, you know, that will certainly pave the way for stablecoin adoption and growth. At the same time, you know, if we're talking about the number one stablecoin in the world, we have the Wall Street Journal, the Financial Times, the United Nations, JP Morgan, various government agencies have all called out Tether as essentially the vehicle of choice for drug cartels, arms dealers, you know, sovereign nations looking to bypass sanctions, money launderers, what have you. That's sort of how the conversation is framed today, right? There are so many benefits to digitizing the US dollar. Everyone wants it. But if we do it in this sort of permissionless way, there are also a lot of potential downsides. And maybe another way to look at this should be, you know, how can we get those benefits of tokenization of the blockchain while still, I suppose, maintaining the trust and stability of the traditional banking system? Greg, I think you've been talking about a potential solution for that, something that resembles a tokenized bank deposit. You want to talk about that a little bit?
So look, this is going to be a big surge, couple of years for stablecoins. They are much more efficient than the siloed dollar solutions that really just work in the US. This lets the dollar, which is already the most trusted currency in the world, basically go global. And so whether it's Tether or USDC, it is it's a better hammer, and it is definitely going to flood through the financial system. The question is, you know, what is the downside of that? And is there something even better? And obviously I'm a big fan of stable coins. I think they're amazing. I back some of the companies that work with them. But I think you did mention a number of points. There is a concern with stable coins, especially in the compliance realm. You may know who you issued them to, and you may know who you're redeeming them for, but you don't know what happens to them along the way in between. A stable coin today, like Tether or USDC, can sit in a non-custodial wallet without identity. And so that does mean that money launderers, terrorist financing, tax evasion are all possible uses for the current generation of stablecoins. And so we've promoted an alternative concept called deposit tokens, which would have identity all the time. It would run on the same rails as stablecoins, but it would have a number of other features, and we can talk some about those. But it doesn't mean stablecoins are bad. It just means that there's variants of stablecoins that are going to come. They're going to be even better in our belief. And so we don't think that one is the replacement for the other. They can be complementary, but I do think that governments are going to basically clamp down at some time on the money laundering, terrorist financing, and other tax evasion challenges that happen with the current generation of stablecoins.
So why don't we take a couple steps back and, for those that might not know what a tokenized deposit is, do you want to sort of paint a picture for people?
Sure. Well, let's just first start. A stablecoin is basically an issuance of a dollar obligation. You can think of it as like going to the casino and buying a poker chip. You come in, you hand over $100, and they give you $100 worth of chips. And you try to feel that you're confident that when you come back with your winnings, or what's left of your losings, that you're going to get your money back. And so that casino is not a bank. They're a business. You have to trust them. They take that money you give them and they put them in a bank. And so that's what a stable coin is. It's a representation of a dollar in a tokenized form. I mean, when I was a kid, we used to have wooden nickels. It's the same thing. You've handed over some money, you have some wooden nickels, and you hope at the end of the day that, you can get your money back. With a deposit token, the difference is you're not handing your money to a third-party non-bank. You actually just hand it to the bank, and the bank issues the token directly. And so that money at the bank is a deposit. And so we call these deposit tokens as opposed to stable coins. And so the money is just sitting there in a bank account. You have essentially a bank account if you've done this with the traditional identity credentials that anybody who has a bank account has. And you could make the rule for those deposit tokens be such that they can only be exchanged with other people who have an identity. And what that means is that everybody who holds a deposit token is essentially a customer of the bank. And so JP Morgan does something like this. It's all within the bank of JP Morgan. They're all JP Morgan customers. But you could imagine a world in which a consortium of banks gets together. They come up with a standard for identity that cuts across all those banks and really covers the whole world, every customer, whether an individual or an institution. And everybody could hold these tokens compliantly. So you'll have one set of tokens running around that have identity and another that don't. And so in a world where we still have laws and there is compliance, those two tokens, are complementary. You could say they're competing. One's compliant, the other not so much. And so if you can get all the benefits of a stable coin, but do it compliantly, we think that might be a winning solution going down the road. And we can talk about some of the other benefits of deposit tokens over stable coins and central bank digital currency as well in this conversation.
Yeah, I mean, speaking to some of those other benefits, right? I think if we rewind a little bit and give a little historical context, right? The Bitcoin white paper was written in 2009, in the wake of the financial crisis. There was sort of this deep mistrust in banking, and you could extend that to, the whole fractional reserve system itself, right? And so a lot of the early people trading into crypto, they needed, something to trade out of, hence the name stable coin. They wanted it to be one-to-one, because like you said, these are not banks, these are businesses that you need to trust. But then also they didn't want to sort of feed into this fractional reserve system either. And so that's sort of why stablecoins are the way that they are. It's not to say that they're necessarily optimal that way, But as a result, they aren't capital efficient. And do you want to talk a little bit as to why that, could be good or bad?
Sure. Well, in the old days, we used to have the gold standard, which meant every dollar that was out there was supposedly backed by a certain amount of gold, and you couldn't have more dollars than you had gold. And that made it really hard to expand the money supply. You had to wait until we actually dug up or got more gold. And so we moved away from that to having a flexible money supply where we could basically print more dollars than there was gold. And it meant that the US dollar was no longer backed one-to-one with gold. Well, today we have a system called banking, where when you make a deposit, the bank doesn't have to keep the money there, just like they don't have to keep the gold there anymore. They can put it to work. There's a capital ratio, but basically for every $10 they take in, 9 of those can be put to work, and they keep 1 on hand in case somebody comes in and needs to take the money out. Those other $9 are used for credit, and credit is what we use to expand the economy. And that's what the private banking system does. It takes dollars, holds 1 on reserve, usually with the Federal Reserve, and lends the other 9 out. With stablecoins, you don't do that. If stablecoin money comes in, those dollars are supposed to be there. They're by law very restricted, and they can't be sent out and basically lent out the way the banking system works. And while that might be very safe, having a system that's based on one-to-one reserves collapses the credit function of the banking industry. And it's like going back to kind of like the gold age, which some people want to do, but they have to remember that was extremely restrictive, and it really collapsed the ability of the country to grow. And so if you want to give up growth and credit creation, well, you go back to a one-to-one reserve system. Whether you're doing that with stable coins, central bank digital currency has the same problem. But if you do build your offering on top of a fractional banking system, which only a bank can do, only a bank is allowed to hold a fractional reserve, hold $1 and put the other 9 to work, then you can use the new technology and be capital efficient. And so that's the big advantage for the economy of having your new innovations happen with a fractional banking system rather than going back to a gold standard ratio, which is what stablecoins do. So look, I'm not saying stablecoins don't have a lot of advantages, but one of them is not credit creation. Deposit tokens allow the banks to continue to do that function. I will jump ahead to say also stablecoins don't have other protections that deposit tokens do. So for instance, a stablecoin is not going to be FDIC insured, right? Especially when the FDIC doesn't even know who's holding the token, right? The bank account, the FDIC knows if a bank gets into trouble, every single depositor, this is how much money they have, and this is how much is insured. And similarly, there's other protections like Reg E, which protects users against unauthorized withdrawals or debits. And so, if your bank account money, your deposit, somebody hijacks it, you get your money back, no questions asked. Don't count on that with stable coins. And so consumer protections are out the window with stable coins, and yet they're still there for deposit tokens. And other benefits are things like a bank, if there is a deposit run, it can go to the Fed discount window and get access to money quickly. If it's a deposit token, they don't have access to the Fed discount window. So these are advantages in solvency, in liquidity, in compliance, a lot of benefits that are there that simply do not exist for stablecoins. And again, I'm not knocking stablecoins. I'm just saying you can take from that advancement and do something even better.
Yeah, I think it's something like 90% of the money in the US is held at banks. And, if you imagine all of that money sort of shifting over to stable coins, you'd essentially collapse the entire economy, right? By sucking out all of that money supply.
Well, remember that it's that money. That's what the money is, that the mortgages for our house, our car loans, basically lending to businesses, that it all requires that credit function. And you want to collapse that out of the economy, don't be surprised with what's going to happen if we essentially, there are gold bugs out there that want to go back to the gold standard. But, that was a long time ago. All those people that are advocates of that, they did not live through the economic consequences for our economy of being tied to one-to-one to gold. And it's no different with a stablecoin.
A core part of this solution really revolves around identity, right? This identity component, and obviously there's the compliance, KYC aspect of it, but there's also a lot of upside to identity in the context of, if you look at DeFi right now, you can get a loan on DeFi, but you need to be over collateralized, right? Unless you have identity or reputation, you really can't have sort of traditional lending markets on DeFi. And then, even if you look sort of globally, identity is this sort of pathway towards financial inclusion as well, right? If these sort of deposit tokens now serve as a pathway to US banking access for people around the world, how do you see this identity story playing out?
Well, we could do identity in sort of an old-fashioned siloed way, which is this one bank knows this identity. And if you're sending money to someone else who's banked at another bank, they know that identity. And you have this problem of like, well, I know my side, you know your side. We don't know each other's side. Or you could have an identity system that's more self-sovereign, more bottom-up, where people just have identity. It's kind of like their phone number. They take their phone number. If they switch from Verizon to AT&T, the phone number goes with them. If people's identity is self-sovereign, what that really means it's just controlled by them, it's portable, it's interoperable, then it doesn't really matter which app you're using, which bank you're banked at. If you're moving something around and it always has identity, regardless of whether it shows up in WeChat or Venmo or Coinbase or MetaMask, then the product itself is compliant at the ledger level. And you don't have to have compliance done, identity done at the application layer. And so that's a huge potential, is to move the identity layer deeper down in the stack so that you can't hold a balance on a ledger compliantly without identity. And that identity is self-sovereign. The person collects those credentials. It could be round tripping their phone number, their government ID, proving some things about themselves, that they are banked at a particular institution, and then sharing that through a zero knowledge proof. So the party on the other side, they know you well enough to trust the transaction, independent of whether you're doing this through Venmo or WeChat, right? That's not the world we live in today, but it would be a world like we don't trust a particular site because you use Chrome versus Safari. Those are just browsers. And what we need to do and are starting to do is to put the identity layer further down the stack. If you put it at the ledger level, it simply says like, I don't care who you are. If you have an address on this ledger and you don't have identity, the way a deposit token is designed is you can't get the money. You have to have identity to get the money. That's not the case with Tether or USDC. All you need to know is the address. Could be like in North Korea, it could be part of the Russian Silk Road. And if the money comes in from that address or goes out to that address, there is no constraint to that happening. It's out in the wild. It's a Mad Max world. And you can still use those ledgers, but you need basically a contract layer that says this transaction is not going to happen without identity. And if it does happen with identity and it looks suspicious, don't be surprised if a suspicious activity report is going to be filed or an investigation. And eventually, guys with guns and badges will show up. And people will say, well, that's terrible for privacy. You can do this in a privacy preserving way on a need to know basis. You can have all sorts of algos that are looking at transaction activity, and the level of credentials that are there to say this looks normal or abnormal, right? And only when it's abnormal and there's basically just cause, there's a need to know, can you do a further investigation and bump that up? And yeah, at that point in time, somebody who has to basically enforce the law is going to be looking at those credentials, is going to be looking at the circumstances of the transaction to figure out whether it's fraudulent or whether it's money laundering, tax evasion, terrorist financing. And that's, I think that's a good thing. Some people think that, no, it ought to be completely anonymous. I don't agree with that. I think it can be private without having to be anonymous. And so that's the advantage of deposit tokens, is they're always going to come with identity first and then the amount of money and whether it can be moved or not.
Yeah, and I think ultimately why a solution like this that sort of marries banking with blockchain has so much potential is the fact that it's more evolutionary than it is revolutionary, right? And so now it's, you have your bank account, but you have some additional benefits, right? Like you can access it with a non-custodial wallet, you can hold your identity there, the payments are cheaper, cross-border payments are a lot more seamless, et cetera.
Well, let me just give an example. In the old days, when you used to buy a laptop computer, it would either be 110 or 220 volt, and if you bought the 110 and you went and plugged it in the you fried your computer. And then eventually those knuckleheads said, why don't we make it so it can do both? And so in this particular situation, I'm saying if you've got $1 and it's represented, why doesn't it have just dual use? It has both a bank account number, but it also has a crypto address. And so it doesn't matter. If your paycheck comes on the old fashioned banking rails, that's fine. But if you want to enter into a DeFi contract, for a loan, on a DeFi protocol, that's fine too. There's no reason $1 can't have two addresses and operate in both worlds. And so we're super supportive of that. And it's just basic accounting and using the old accounting and the new accounting, for the same dollar.
Yeah, and at the end of the day, this is about digitizing money. We've needed to do that for a very long time, and while making it interoperable as well. But any final thoughts for you, Greg?
Well, the one thing I would say is I think there's like a confusion on language. There's crypto, and then there's distributed ledger technology, there's blockchain, and there's tokenization. Okay. You can have something be tokenized without it being crypto. It doesn't have to be on a blockchain. It doesn't actually have to be on distributed ledger technology. Now, it might be great to use distributed ledger technology and blockchain because it's just easy for everybody to access it, right? That's not JP Morgan's view. JP Morgan's going to just put it on a chain, and they're just basically using a permission chain. It doesn't really matter whether that chain was Oracle or it could be like a MySQL database, but people are getting caught up in the technology and the linguistic names. All that matters when something is tokenized is, can it move around the same way a poker chip moves around? Once you have a poker chip, you can move from one table to the next. You can use the same poker chips at the blackjack table as you can at the poker table. We're just talking now about a poker chip that can be used at the casino across the road, and now you can use it at 7-Eleven as well. So let's appreciate the value of tokenization independent of distributed ledger technology, blockchain, and crypto, all of which are good. But let's just value tokenization because it's not just going to happen to the dollar. There's $470 trillion of assets out there. So eventually the title to your house, the title to your car, those things can all move around as a token, and that will be more efficient, faster, simpler, more interoperable for all of us. So the move toward tokenization, I believe, is inevitable. Obviously, I think we get there better and faster if we did it with distributed ledger technology and blockchain. And I think one of the things it should interoperate with is crypto. But you don't need all that stuff to do tokenization. And you shouldn't be afraid of tokenization, even if you're afraid of those other things. I'm not afraid of any of those things. I want everybody to get comfortable with it. But you don't have to swallow all four of those pills all at once to get comfortable with the fact that a deposit token might be a great way to basically make just interactions between all these different transactions, all these different websites, all these different entities more portable, more interoperable, cheaper, faster. So I'm super excited about that. Love stablecoins. All I'm here to say is deposit tokens might be even better.
Yeah. So let's just say 2025 will be a big year for tokenized money.
It is. And I think stablecoins are going to do very well. I think we're going to see stablecoin legislation. And, I'm hoping that by the end of 2025, people will actually start to know what a tokenized deposit is, as well as a stablecoin.
Awesome. Thank you, Greg.
All right. Thanks, Alec.